Private equity, a dynamic and influential concept in modern finance, embodies the art of investment and strategic business transformation. Rooted in the fundamental principle of injecting capital to drive growth, private equity firms epitomize the synergy between financial acumen and operational expertise. At its core, private equity entails the acquisition, management, and eventual divestment of ownership stakes in companies, often in pursuit of generating substantial returns for investors. This concept serves as a conduit for reshaping enterprises, fostering innovation, and amplifying economic prosperity. The basics. One of the defining features of private equity is its versatile approach to investments. Private equity firms deploy a range of strategies tailored to the unique needs and potential of each investment. Leveraged buyouts, LBOs, for instance, involve the acquisition of a company primarily using debt financing with the aim of enhancing operational efficiency and creating value. Venture capital, on the other hand, focuses on nurturing early-stage startups with high growth potential, infusing them with capital and expertise to facilitate expansion. Additionally, growth capital investments fuel established companies seeking to scale their operations or enter new markets. Private equity firms are more than passive investors. They actively engage with their portfolio companies to drive transformative change. This involvement extends beyond financial contributions as private equity professionals leverage their industry knowledge and operational insights to unlock untapped potential. From streamlining processes to fostering innovation and restructuring business models, private equity's hands-on approach often results in increased profitability and long-term sustainability. As private equity firms collaborate with management teams to craft and execute growth strategies, they become catalysts for organizational evolution and value creation. Furthermore, the exit strategies pursued by private equity firms underscore their commitment to generating returns. Initial public offerings, IPOs, enable portfolio companies to go public, capitalizing on increased market visibility and liquidity. Alternatively, mergers and acquisitions, M&A, offer avenues for consolidation and synergistic growth. These exit mechanisms crystallize the fruits of strategic enhancements, ultimately benefiting both private equity investors and the broader financial ecosystem. Private equity firms have emerged as powerful forces in the financial landscape, profoundly impacting the corporate world through strategic investments and restructuring initiatives. We'll highlight the historical evolution of private equity, spotlighting key players within the industry, elucidating their global reach, and offering insights into their operational methodologies. Historical context. The genesis of private equity dates back to the early 20th century, gaining substantial traction in the 1980s with the advent of leveraged buyouts, LBOs, and venture capital investments. Notable among these developments was Kohlberg Kravis Roberts & Company, KKR, which pioneered the LBO model characterized by the acquisition of companies using substantial debt leverage. Over the years, private equity's scope expanded to encompass diverse investment strategies, including growth capital, distressed asset acquisition, and mezzanine financing. The key players. The landscape of private equity is dominated by a select group of influential firms, each leaving an indelible mark on the industry. The Blackstone Group. Established in 1985, Blackstone has evolved into a global alternative investment powerhouse. Its extensive portfolio spans real estate, private equity, credit, and hedge funds, solidifying its stature on the global stage. KKR, Kohlberg, Kravis, Roberts, and Company. A trailblazer in private equity, KKR's foundation in 1976 marked a pivotal moment in the industry's trajectory. KKR's innovative leveraged buyout approach reshaped the landscape and continues to influence industry practices. Carlyle Group. Founded in 1987, Carlyle's multifaceted presence encompasses private equity, credit, real assets, and solutions. The firm's growth-focused strategies have garnered substantial attention and success. Apollo Global Management. Established in 1990, Apollo's expertise in distressed asset investments and value-driven methodologies has set it apart. The firm's versatile approach to private equity has contributed to its noteworthy accomplishments. Global footprint. Private equity firms strategically position themselves in key financial centers worldwide, with notable concentrations in major world cities all across the globe. Epicenters such as New York, Boston, and San Francisco serve as incubators for some of the largest private equity firms, underscoring the industry's robust presence in the US. London, Frankfurt, and Paris stand out as pivotal European hubs, housing an array of private equity firms that contribute to the region's financial vitality. The growth of private equity in Asia is exemplified by cities like Hong Kong, Singapore, and Tokyo, which serve as fertile grounds for investment and innovation in the Asia-Pacific region. Private equity firm fundamentals. Private equity firms engage in a spectrum of operational activities. Vital to their functioning, private equity firms raise capital from institutional investors, high net worth individuals, and pension funds to establish investment funds. Rigorous due diligence precedes investments, entailing comprehensive research and analysis of potential ventures to ascertain feasibility and growth potential. Private equity firms procure companies or stakes in companies, often employing a blend of equity and debt financing to facilitate acquisitions. These firms collaborate closely with portfolio companies, deploying their operational expertise to optimize processes, implement growth strategies, and enhance overall profitability. Private equity firms engineer exit strategies to unlock returns for investors, which can involve initial public offerings, IPOs, mergers, or secondary sales. In essence, private equity is a transformative force that transcends traditional investment paradigms. Its multidimensional approach, characterized by strategic investment, active management, and value-driven exits, continues to redefine industries, empower entrepreneurs, and shape the economic landscape on a global scale. Private equity firms assume pivotal roles in global finance by driving innovation, catalyzing business transformations, and generating substantial investor returns. Their widespread geographical presence underscores their influence, fostering cross-border collaboration and economic growth. The adaptable nature of private equity ensures its enduring relevance, shaping the trajectory of businesses and economies for years to come.